What is going on, guys? It is SquireTrades here back today. It is September 16th, 2025 at 3:30 p.m. Eastern Standard Time. And boy, did we catch a beautiful trade today. I'm excited to talk about it. Let's jump right into it. So, I follow a four-step checklist. I have married this list. It has married me. We are in love. And this checklist here is what I believe is necessary to potentially make millions of dollars in the financial marketplace. You need a high time frame bias, an opposing rate of liquidity, a displacement fair value gap or displacement inverse fair value gap with a fair value gap overlapping. And then you very simply need to execute, right? We covered it yesterday. I'll cover it once again today just because I want to hammer the point home. What I said yesterday and what I said the day before that and what I said last week is this. On the month, Dixie, the dollar, the United States dollar, we are short. We are short down to at least this external, and I want to watch how price reacts to this level of liquidity, right? Same thing down here on the week. We have been consolidating for weeks and weeks and weeks now. Eventually, we're bound to displace or manipulate and then reverse, right? At least in the short term. So, knowing that down here on the daily chart, we covered this yesterday as well. Bearish fair value gap, bearish engulfing out of the bearish fair value gap. You would expect to see continuation yesterday, as we did after Friday. Friday was accumulation, right? So we were expecting some kind of continuation coming into Monday. We got that continuation and then had a great move Tuesday, today, overnight. Using that, once again, four-step checklist, high time frame bias over on the Dixie, just covered it, short. High time frame bias over here on the Euro, 6E, the futures contract that represents Euro USD in the Forex world. What do we have? Monthly, targeting at least this external. Honestly, I believe you could see this external be met. I believe you could see this external and maybe even this trend line liquidity here as well. We call this low resistance liquidity in the ICT world, or I wouldn't really call these relative equal highs, but you can kind of see that we have four different points here in which I would be targeting and I will be targeting in the coming months. I don't expect it to be delivered all at once. That's not how the market works. But generally speaking, I am long on the euro. I'm short on the dollar on the higher time frame, right? So with that in mind, I come into the session every single day looking for an opposing rate of liquidity before I'm doing anything else. So I get in here this morning. What do I see? What I see is up here. You can see today's Tuesday. We had retail sales at 8:30 a.m. this morning. You can see that wick right here. Right here is that exact wick. And you can see over here off to your left, beautiful fair value gap. And what did this wick do? This is important. This is where we get our sweep of sell side liquidity. We have 1, 2, 3 swing lows stacked all on top of each other. In fact, these are equal lows. And just below that, we have one more low as well. Relative equal lows, right? Simple. So news, generally speaking, when we see news, we're expecting news to do some form of manipulation. Today, you saw that on the 15-minute chart. You also saw that on the hourly chart. This long wick here, this is a bullish fair value gap. But this long wick here, when this candle closed, this is what we call a swing failure pattern. You could call this 15-minute turtle soup, whatever you want. The idea remains the same. All we did was sweep liquidity. That's it. Just a liquidity sweep. We swept previous hourly low. We swept these lows over here, and it's even more clear on the 15-minute chart. So what was I looking for after this? Well, revert back to our handy dandy checklist, wherever it is. I seem to have lost it. It's okay. The next step in our checklist would be a displacement fair value gap, right? But that one is kind of subjective, and you can build your way into how you want to enter a trade or what your definition of displacement is or what you need to see for rules of entry, right? For me, this 1 hour close, that's a swing failure pattern. This 15-minute, that's sweeping sell side liquidity. And we have this big bearish fair value gap here. Well, what do we do to this bearish fair value gap? At 9 o'clock, we inverse the bearish fair value gap. We created an inverse fair value gap. So what did I do? On the next candle's wick, I got long. I got long and I placed my stop down here. Not arbitrarily, it's just I'm not expecting this low to need to be retested, right? I would be expecting this order block to hold. I would be expecting this inverse fair value gap to hold, et cetera, right? And what we also did is we ended up creating a breaker. We ended up creating a market structure shift, another fair value gap, right? But we'll get into that. Let's click over to M6E. We'll do that in a second. You can see this is the trade I took in the beginning. And I took it with 3 contracts. I took it with 3 micros, not minis. I took it with 3 micros. What ended up happening is we displaced through this point, closed above, and we created a fair value gap. What did I do when we retraced back into the fair value gap? I took my position from 3 contracts from 3 micros. We'll pop over to the execution in one moment. From 3 micros to 7 micros. I more than doubled down on my position inside of this wick. And what did I do? I moved my stop, right? So as a general rule, when I'm executing, if this was my first trade, if I'm going to add into a trade, then I must move my original position stop loss. I tend to believe and tend to operate under the rule of I need to be able to move my first position to break even or very close to it. So I was able to take my original position, 27 pips, and move it all the way to 6, right? And I entered here, this is my second position, and it shared the same stop loss as my original position. What ended up happening is between the 2 positions averaged together with where my stop loss was, I was risking $61.25. And my take profit was over here on the week. We have 2 swing points. We ended up taking both of them. But I believe this was the one that I ended up getting out on. Let me check and make sure. Yes, or it was this one here. In any case, I was targeting buy side liquidity, right? Which is another one of our rules. Once we execute, your target is always opposing liquidity. So I was targeting buy side liquidity in this case as I was long, right? I ended up getting out on, I believe it was this candle. Yes, it was. This is the level I was targeting, 1 hour buy side liquidity. I also had this level marked out as well. Once we swept this level, my stop moved once again. So I was break even and I had moved my stop loss into profits, right? I believe I have my trading journal. I do here. And I will cover this trade as it correlates to my journal. Executing off of a 15-minute inverse fair value gap, we put in a large manipulation off of 830, expecting low to hold as it swept sell side liquidity and is now high resistance liquidity. I said, we'll be watching how we react to the levels above us from the 4-hour chart, assuming price begins to move in our favor. And this is where I said I was in with 3 contracts, right? Swept an intraday level, price waiting, but I didn't add. I took over half the risk off the table. So what we did, zooming in here, is we swept this 4-hour level of liquidity, and I was just paying mind to, hey, I want to see how we react to this liquidity. I want to see how we react to the next one. And finally, where I had my take profit at, right? I ended up taking over half the risk off the table. Either we will displace above this level and hit take profit, or we'll begin to consolidate and chop in the range. Should we consolidate and chop around, I no longer want to be in this trade, hence the aggressive stop loss management, right? So we displace through this level of liquidity, and I was watching this low, and I wanted this low to hold. I wanted to get risk off the table quick. Remember what I said yesterday? What I said was I would consider today a high-risk environment. It's pre-FOMC. Today is not a day where you need to get a lot of risk on the table, right? I never went above $61 worth of risk on the table. That's a small position to me. I'd like to be in $100, $150 positions if I can when the time is right. Today was not the time. Today I caught a good trade, right? But I was still sized down, and that's important. I ended up adding in on the 15-minute fair value gap retest. The second P&L is my second position, and the third one is the average of two, only 50 to 60 bucks on the table, looking for over 200, right? So this is my final screenshot. I did get into 7 contracts. You can see this was my original position, right? Remember when I said my stop loss was down here? When I added in, and you can see where I added in here in this 15-minute fair value gap, I moved my original position from all the way down here to up here. And then I had the same stop on my second position and the average of the two so I could see what my risk to reward was looking like, right? So let's pop back over here into M6 and I'll show you the exact execution that I ended up taking. Here you go. Here she is. I got in 3 at 1.1873 with a stop loss down here. I believe I did 1 pip extra just for spread. And 1.1878. And my stop loss would have been here as well, as it was shown in the journal. This is so important. And now that you've seen these executions, let me take this off for a moment. Let me go grab this liquidity that I was targeting as well. Boom. Right. There it is. In all her glory. And so between these two averaged out positions, you can see over here, I was at 1.18759 with the stop at 690. So 759, I'll show you the position averaged out. We'll call this good. Down at 690. Boom. And I ended up getting out at this level of liquidity for a 4.43 R trade, right? So you can see how what I've been talking about and the way that you need to add in is so important. And I finally got it right. I mean, this is just a textbook trade. Every single thing about this is unbelievably beautiful. From the 8:30 news manipulation, sweeping sell side liquidity, respecting the bullish fair value gap, respecting the 1 hour bullish fair value gap that we have right here, and creating this inverse fair value gap, continuing our displacement, closing above this swing high, retracing down into this fair value gap, and delivering a strong close on the 1 hour chart. All we're looking for in that next hour is just pure continuation. And man, is that what we got. At 10:15, this is the exact candle I got out on. I had a limit, as you can see over here in the journal. My limit was set at 1.19070, 1.19070, and that's where I ended up getting out. It was an unbelievably beautiful day, and I believe, let me see if I can show you. Here we go. This is what it shook out as. Here you go. This is what it shook out as on my MyFunded Futures accounts. I got $261.86 per account, and I only risked $61.25. I don't know how I could do it better than that. My trading partner, Sam, and I absolutely killed this today. We had a lot of good conversation this morning about, the toughest part of this game is being willing to swing the bat every day, showing up every day, not only to execute and to learn and to be better, but to really make an effort to follow a process, to really make an effort to understand your process, to simplify things down, to internalize them, and to really give it the best we can, because that's really what this game is about. Everyone's on their own journey. Everyone will find profitability when it's their time. Everyone will make money when it's their time. And that's what we've done, man, through the hard times, through the easy times, through the times when we were making money, through the months where it's just pure red and you feel like you can't buy one. We've remained consistent, and that's what I'm most proud of. We show up every day. We work hard. We study. We execute when the time is right. We kept risk off the table. It's the day before FOMC. We talked about it yesterday. I've talked about it today. And I'll say it once more. Man, if you're out there and you're a trader, don't trade tomorrow morning. Probably don't even trade after FOMC. Make your own decisions, right? But just understand that I've been doing this for a few years now, and I was very stubborn and always wanting to trade the morning of FOMC. I wanted to trade at 2 p.m., at 2:30, at 3 o'clock. I wanted to trade everything I could trade. And if I could just tell you one thing, it's keep your risk off the table tomorrow morning. If you have to press a button, I encourage you to paper trade. If you have to press a button that isn't a paper trade, I encourage you to do so with one micro, a very small size. And I encourage you to stay with this. Don't give up. I believe in you. I'm sure there are other people that believe in you as well. You can do this. It's a hard game. Stay consistent, follow your rules, and you're going to make it. With that being said, it's been Squire Trades, 3:46 p.m. It's a longer one today. Thank you for tuning in. If you're watching this, I appreciate you. I hope you had a great day today. I hope you had a great day yesterday. I hope tomorrow's beautiful. And I pray you have a great rest of the week. We'll see you next time.